There are two very exciting developments currently taking place in the world of investing. One is the growth of evidence-based investing. The other is the increasing popularity of ethical investments. In fact, we're now starting to see products that combine the two. Investing for Catholics provides what it calls faith-consistent investment products rooted in financial science. It was the brainchild of Mark Hebner, founder of Index Fund Advisors, based in Irvine, California.
So the idea started actually with a fund that was created at Dimensional Fund Advisors as a request from a Catholic organization. They liked the idea of an index type investment, well-diversified, low cost, but they also had their Catholic values and they wanted investments that were consistent with those values. And so that requires a screening out of certain companies who engage in businesses that are inconsistent with Catholic values.
The screening process is really pretty rigorous. It follows very closely the United States Conference of Catholic Bishops' socially responsible guidelines. They're looking at excluding companies that are associated with anything relating to abortion, either through surgical means. It also includes weapons of mass destruction, anything relating to alcohol, tobacco, gambling, pornography, and also includes any company that has been charged with human labor infractions.
There have been a number of studies on ethical investments and the impact that screening out so-called sin stocks has on long-term investment returns. So far, the findings have been inconclusive. Investing for Catholics says its portfolios have delivered very similar returns to passive portfolios with no such screening.
While they're screened for Catholic values, they also apply the same risk-return characteristics as a non-screened portfolio. And we've done a lot of research in this area, and again, the same old rules apply, whether it's screened or non-screened. If you have proper asset class exposure, and if you have massive diversification, and you keep your fees low, then your investment returns are going to be very comparable, if not the same, as to a non-screened portfolio.
And when we start off with 3,000 companies in a broad market portfolio, and then take out maybe 800 or so, we're still left with 2,200 companies. And so we have a very diversified exposure to markets. And even within these portfolios, we still do a little small and value tilt. Even that is designed to have a little higher return than a traditional, let's say, Russell 3000 index.
Of course, it's not just investors with religious convictions that screened portfolios appeal to. There are also passive investment products specifically aimed, for instance, at those who want to invest in a way that doesn't harm the environment. It's great that consumers now have this sort of choice, but if you are going down the ethical investing route, it's even more important that you seek professional advice. Goodbye. All over the world, people are being very poorly served by the investment industry at the moment. That's wrong. We're trying to redress that. We have feedback from investors around the world. They say, thank you very much for explaining that point. I really didn't understand it until I saw that video. We are giving investors, the wider public, the full picture.